Okay, let's dive into chapter 12. The first exercise that I assigned was number 1, and it reads, 72, a developer of radiology equipment has stock outstanding as follows. 60,000 shares of cumulative preferred, 2%, $60 par, and 300,000 shares of $20 par common. During its first 4 years of operations, they had the following dividends: 51, 105, 81, and 120. So before we do anything, the first thing we have to calculate is how much are the preferred shareholders supposed to get. So if you could, with me, use your calculator, take 60,000 shares times $60 par, 60,000 shares times $60 par times the 2%, or times 0.02. That's 72 grand. So every year the preferred are due 72 grand. Now it's cumulative, which means if they don't get the 72 grand as they're required to, it carries forward. So if we look here, year 1, they had $51,000. So who's going to get it is all of it's going to go to the preferred. In year 2, they had $105,000. So the first thing that we take care of is the $72,000 that's due in this year. And then last year, they only gave them 51. They're supposed to get 72. So there was a deficit of 21. So in year 2, they're going to not only get the 72, but because there's enough room, they're going to get 21 as well. So the 93,000, the first 93,000 of the 105 is going to go to preferred. The leftover 12 will go to common. And then years 3 and 4, if you notice, we're far over the 72. So they'll get their 72, and the excess, in the case of year 3, 9 goes to common, and 48 to the common again in the 4th year. So what they're doing here is just calculating the earnings per share. So of course there's 60,000 shares for preferred. There's 300,000 shares for common. So if they get what they're supposed to get every year, theirs is going to be $1.20. The next one is number 3, and it reads, on January 22nd, Jefferson County Rock Incorporated, a marble contractor, issued for cash 210,000 shares, $30 par at $34. And then on February 27, it issued preferred stock $9 par at 12. And it says, what do these journal entries look like? Well, we always record the common or the preferred at par. So there was 210,000 shares issued. Par is 30, but we sold it for 34, so there's a $4 difference. 4 times 210 is $840. All $34 times 210 goes to cash. Likewise, for the second entry, 15 at par. They sold it for 12, so there's a $3 difference times the 15 goes to the paid in capital in excess of par, and the debit again is to cash. Number 4, it reads, this is no par stock. However, it says this Helena Carpet issued for cash 750,000 shares of no par common, and then it says with a stated value of $1.50, and they sold it for $4. On June 30th, for cash, 17,500 shares of preferred $50 par at $60. So in this one, again, they just want you to do the same 2 journal entries. This stated par, or the stated value, is kind of treated like par. It's not officially par, but it's like par. So they issued 750,000 shares. There is a stated value of $1.50. They sold it for 4, so the difference goes to this paid in capital in excess of stated value, and of course all to cash. With the preferred, They sold $17,500 at par. They actually sold it for $10 over par, so the $17,500 times 10 will go to the paid-in capital in excess, and again, a debit to the cash. Number 5, it just reads here, on November 23rd, they acquired land in exchange for 14,200 shares, $25 par, when the market was 34. So they gave them 14,200 shares at par, and then there's a dollar difference here again. The value is 34, the par is 25, so that's all going to go to that paid-in capital in excess of par, and we therefore are recording the land at fair market value, which quite frankly is similar to here. Cash, of course, is at fair market value too, so we record it at fair market value. The next one is number 8, and it reads, this wholesaler of office products was organized on February 5. They authorized 50,000 shares, so this is just the authorization, 2% stock, $60 par, and 1,000,000 shares, $8 par common. On February 5, they issued 700,000 shares of common stock at par. Well, very straightforward. Then common stock and a debit to cash. No APIC. Issued 1,200 shares of common stock at par to an attorney for legal fees, so organizational expense. Debited, and again, at par. Should stop here and say, you'll probably catch me say APIC, which is additional paid-in capital. The author uses paid-in capital in excess of par. In the previous years, and when I was in school, we always called it additional paid-in capital, or APIC. So you'll hear me say that interchangeably, but this author uses paid-in capital in excess of par dash. Is it common or preferred, and soon we're going to hear it on treasury stock. April 9, issued 40,000 shares of common stock in exchange for land, building, and equipment with the fair market values of $120, $280, and $80, respectively. And we said we'd record those at fair market value, so there you go. They gave them 40,000 shares recorded at par. It doesn't balance. If you would look and add, that would not balance. Our entry would not balance. So you have to put in a credit, and that credit is to paid-in capital in excess of par for 160 grand. You can probably hear my dog barking or growling. I think she sees somebody at the door. And then on June 14th, issued 25,000 shares of preferred stock at $82 cash. So in this case, 25,000 shares at par. There is a difference of 82 minus the 60 at the 25,000 shares, so that'll go to paid-in capital in excess of par, and the debit, of course, all to cash. Number 9, the declaration, record, and payment dates in connection with a cash dividend of $1,425,000 on a corp's common stock are July 9, August 31st, and October 1. Journalize these entries. What they're really getting at here is when we declare it right here, the liability comes into play. So we debit dividends, but we record the liability. The record date is nothing more than we figure out who owns what. So there is no journal entry, really. October 1st is when we actually alleviate that payable and pay it. That's when we actually pay it. All right. Number 14. This Mystic Lake bottles and distributes spring water on July 9 of the current year. They reacquired 60,000 shares of its common stock at $42 per share. On September 22, they sold 45,000 of that 60 for $51, and then the remaining at 40. So if you look at here, the first 45,000 they reacquired it at 51, or they sold them at 51, which is good because it's over the 42 that they brought it in at. The second transaction of 15,000 shares, they actually sold them for less than what we bought them for. So it says journalize these entries. So first, we bought all 60,000 shares at 42 bucks. And what is important to notice here is, of course, we credit cash. We put this into treasury stock. We don't debit common stock. It's treasury stock. On September 22, when we sold that first 45,000, we sold it for 51, so we record cash. But what's important is we don't care what par was. Let me repeat that again. Initial, and it would have been nice in this problem if they would have told us what par was, because it's irrelevant. What we do is we credit the treasury stock that we're selling for what we brought it in at. So that's kind of like their new par. And then the difference, 51 minus the 42, is all going to go into this new paid-in capital in excess of par. Excuse me, it's not par, but it's paid into capital, but from treasury. So we actually will have three different kinds of paid-in capital accounts, potentially. One for common, one for preferred, and then another one for treasury. Then on the 23rd, we did the same thing. What's important is we credit the treasury stock for what we initially brought it in at. We debit cash, of course, for what we sold it. Now there's a $2 difference there, so now that paid-in capital is going to be debited. And we can do that because there is already a substantial credit balance there. In your reading, you will notice if this transaction never happened and then we sold these shares, that amount would have to be initially debited to retained earnings because there is no paid-in capital to take it against. That takes care of number 14. So what's the balance? Of course, well, the balance is the net. And it says, for what reason might Mystic Lake have purchased this treasury stock? And of course, there's many reasons, but here it reads, they may have purchased the stock to support the market price, to provide shares for resale to its employees, or for reissuance to employees as a bonus. So again, there's various reasons. And then the last one that we'll do before we take a break is number 20. And number 20 is quite straightforward. This kind of goes back to your Principles 1 class. It says put together your retained earnings statement. So beginning retained earnings plus net income minus dividends is our ending. And I guess the only thing that they're trying to show you here is this dividends number is all dividends, whether it's cash or stock. So 3.6 million is the sum of the cash and the stock dividends. So beginning retained earnings plus net income minus dividends, all of them, is our ending retained earnings. We'll take a break there and then we'll finish the last three problems.